Golden Rule Radio is brought to you by McIlvaney ICA. ICA has been America's foremost precious metals brokerage firm since 1972, helping you build a strategic precious metals portfolio. Call 800-525-9556 to buy gold, silver, platinum, or palladium today, or go to McIlvaney.com. Welcome back to Golden Rule Radio. It's a pleasure to be back with you this week. A lot of action, actually, since our last recording this time last week. Gold up $36, which is 2%. Silver this week is up $1.20 from the last show, 5.4%. Platinum also up 3%. The only one that kind of lagged was palladium. But without further ado, from a brief market recap, I'm going to hand it over to you, Miles. Let's get into the nitty-gritty.
Well, and let's not forget the most important figure there, and that's the dollar down 1.6% since January 4th. Yeah. So it's almost like these things are occasionally intertwined. For those of you that are curious, why doesn't gold go up or down when the dollar goes up or down? Sometimes it does. That certainly averages out over time. So we will take a look here at the gold chart, currently sitting at 1827 at the time of this recording. We looked at this multiple bottoms down around 1680 over the last 8-12 months, and it looks like we've been stair-stepping up. You know, I've been drawing a lot of triangles on our charts here for the last few months, but not only have we been seeing, like I talked about last week, this top channel stretching outwards, where we're not putting in higher highs, but we're putting in higher highs that keep bringing the top end of that channel up. Well, here looking back since the bottom we put back in July and August, and then started stair-stepping up the bottom end of the gold chart in September, we're now starting to put higher lows in as well. So again, not dollar price higher highs, not dollar price higher lows, but higher highs and higher lows in comparison to what it had been previously. So hopefully this is represented in a way that makes sense for you on the chart I'm showing you right now. And that's very optimistic for gold. And I think coming off the heels of what the Fed closed the year out saying, where unemployment numbers were at the end of the year, and my Lord, what we're looking at for inflation next year, and this is stated inflation next year, it's not surprising at all that after about 12 or 18 months of gold taking a little bit of a breather, we could, dare I say it, be seeing the next leg up in gold in the near future.
I hope you're right, because last week was a little deflating for those that had suffered through December in hopes of seeing a reignition of some bullish activity after the first of the year. It didn't play out that way necessarily, and now we're starting to see it. But it all goes to the dollar, like what you're saying. We're seeing a lot of reaction. We talked a couple weeks ago about that tug of war between gold fundamentals from a bullish and bearish standpoint. And at any given point, you're going to react to the news in these small market moves. These aren't huge moves. I would say it's a significant move in the dollar, just because not only did we come down below the 96, but we flew through the 95 into the 94s. And so why don't we just go to that chart here just to give us a little perspective before we jump into the other metals?
Sure, I think that's a great idea. One of the big questions, probably the biggest question we've been getting is, with all of the COVID spending, all of the package spending that the government has been doing, why the heck is the dollar up? And my argument to that would be because the dollar is in relation to other countries. And for a period of time, despite what we were doing, other countries were doing it too. And the dollar had just gone through 2020. Had just gone from over 100 on the dollar index down to below 90, a significant decline in the value of a currency, an over 10% drop in a currency in less than a year. To see it rebound back up, in this case about 2/3 of what it came down, was completely reasonable through 2021. And lo and behold, it looks like it topped out right at the end of 2021 because, like you said, we blew through that 96 to 95 mark. If I'm not mistaken, most of that happened in a single day. And now we're sub 95, and that looks dangerous as far as purchasing power for the dollar goes. And with the expectation of what inflation is going to be this year, and the fact that they've announced no interest rate hikes anytime before March, we'll see if they live up to that, or even if they would do something in March. Looking at the dollar declining, potential spending packages, Nancy Pelosi talking about another COVID spending package. There's so many reasons out there to be getting out of liquid dollar positions and looking for other type of safety assets to keep your non-invested money into.
Yeah, and it's not going to be bonds. I mean, there's been a huge bond sell-off. Bonds, people have to understand, they really have nowhere to go but get more expensive. But this big bond sell-off is another reason that it's coinciding with this dollar weakness. So first of all, to your point, the basket of currencies that makes up the U.S. dollar index, the U.S. dollar was at a 4-year high against the yen. So that's relative strength, right? Same thing with the euro weakness. We're seeing some of that because their problems economically and certainly from a monetary currency standpoint are worse than ours because the whole world is affected by COVID and the response is proportional. That being said, this bond sell-off's really got the markets rattled, and why you would move any of your assets into the bond market right now. I mean, we've already got the numbers that show that over a 20 and a 50-year period of time, gold does a much better job of hedging and balancing a portfolio against stocks than bonds do. But yet people cannot accept the reality that bonds have nowhere to go. And it's a bubble that is burst without technically bursting yet. So don't chase that, but you do have to be prepared for this dollar weakness to impact you. Fed Chair Powell was in front of the Senate panel for his confirmation hearings, and he goes through that process. And some of the things that he has said here in the last couple of days, we'll get into a little more detail, but just rest assured that yes, the inflation numbers came out and exceeded 7%, highest level since June of 1982, but that's 7%. December was up 0.5% alone in the inflation number. So be prepared for continued weakness in the dollar. That's strong for the gold markets. It will be strong for the white metals as well. So let's look a little deeper at silver.
Yeah, and we're seeing very similar patterns in both silver and platinum, the white gold alternatives, the industrial and precious metals. Silver put in a bottom right here at the end of 2021, another touch into that low just shy of 22. So you would be expecting silver to make its next move up, going up to touch that declining channel at the top. Platinum also looks a lot like silver, where it had put in a bottom end of its channel around 900 and is starting to stair-step up as well. So silver and platinum should both be stair-stepping up towards the top end of its channel. Gold should have been stair-stepping down, and it's not. So we're seeing all three metals, 2 that should be and 1 that shouldn't be, and all 3 of them are going the same direction in the short term, and that's up.
So the reason I think that we're seeing that happen, obviously, is the news that comes out with the highest inflation rate crossing the 7% line finally, the expectations there, and then Powell's talk in front of the Senate committee. Despite the fact that he mentions rate hikes in 2022, it's almost like the metals have forgotten that. Until it starts to occur instead of just being talked about, I think the metals are going to continue along this climb based on the inflation expectations. What is the central bank going to do? Well, okay, let's say they hike rates in 2022. That's the expectation. It was going to start in May. Now they're talking as early as March. To what? A quarter point? Are they going to do 3, maybe 4 rate hikes at 25 basis points each?
Yeah, the Volcker era is over.
Yeah,
that's not, I can't imagine that happens again.
No, they would have to get it to 10% to have the same sort of tightening effect that Volcker had back in the 80s. Until you start getting a positive real rate of return, you don't have to worry about it being weak for gold. So what if they hike rates 1% total for the year? It's just not going to put a dent in it. They're going to have to go cautiously in order to see how the markets react. So expect very little hikes and the frequency won't matter a whole lot. But that being said, we're also looking at whether or not they shrink the Fed balance sheet. The economy and the equities markets are far more sensitive to a shrinking of the balance sheet, which is 8.76 trillion. Think about that as Federal Reserve assets that they've invested in. That's their portfolio. It has ballooned to almost $9 trillion as a result of the great financial crisis, followed by COVID in 2020. Powell was cautious there. He said, no, that's going to take us 3 or 4 more meetings before we decide what to do there, because that's what the markets hate. In fact, I'm going to show you how the S&P 500 has fared since 2008, since that financial crisis, and they started throwing money at the problem. Look here at how the Fed balance sheet corresponds almost directly with the S&P 500 performance. And we can zoom in a little bit more to it. You can look at just the most recent with the COVID response. The Fed balance sheet is up 112%, and the S&P 500 is up 108%. That is a direct correlation, and that should tell the listener everything he or she needs to know about why do they keep throwing money at the problem. It's stimulus. They're trying to counter economic downturn by juicing the markets, and it's to great effect. So people say, well, if the markets are going to go the direction of the Fed and the Fed starts to contract and shrink its balance sheet, isn't that strong for the dollar? Isn't that bad for gold? No, I'm going to show you a couple other charts here. You'll see that stocks are flat or even respond negatively when they deleverage. So going back to that 2018 to almost 2020 period of time, the last time we deleveraged, the markets didn't like it. We had initial declines. It ended up flat basically during that period of time. There just was no stimulus. I remember President Trump being irate at the Fed for continuing to shrink its balance sheet. Well, look what happened to gold in that same period of time, up 17.88% during that time of deleveraging. So don't be afraid, gold investor, if they start to hike rates. Gold does well in turning points. Gold does well in times of deleveraging. This is one small example of that. So keep your eyes on what matters most. That's long-term dollar strength. What does gold do over the course of your lifetime?
Well, and we remember back to December in anticipation of the last Fed announcement of the year and in anticipation of maybe some hawkish speech coming out of the Fed.
Which is what's happening.
We did have a stock market. Let's not call it a crash, but at least a decline in anticipation of that. And then a turnaround after the announcement came up. And now the Dow Jones has put in another higher high. So the Dow Jones, at least the industrial side of the Dow Jones, breaking almost to 37,000 and putting in higher lows as it's stepped up. Now, here's where I think that matters. So, okay, they not going to raise rates any sooner than March. Of course, the stock market's going to go up. But here's what I find interesting about that. The NASDAQ failed to put in a higher high and has put in 3 consecutive lower lows. The Dow Transports missed putting in a higher high by a significant margin and looks like it's starting to step down. So the only market that we see going up right now is actually the biggest stocks in America. And where would you think the Fed balance sheet is going to be investing the majority of their money?
That's
Probably the biggest stocks in America.
Along with other sovereign funds and nations, right? So it's not just the Federal Reserve. This is a global trend of investing in the U.S. equities.
So you're seeing a decoupling of the biggest companies in the U.S. and everybody else within the equities market. Kind of makes you wonder where the investment money is coming from. Oh, wait, we don't have to wonder.
That's right. And the Fed is in this situation of battling employment. Suddenly they're like late to the game. They're finally admitting, okay, hey, we have an issue here. They've been so focused on employment numbers that they let the inflation run like a runaway horse that now has to be reined in.
Like a horse loose in a hospital.
Yeah, there you go. But with there not being any expectation of them shrinking their balance sheet, because they can't raise rates and shrink the balance sheet, that's going to be way too economically devastating, or at least equities market devastating, right? So the stocks hating deleveraging, we're going to see what they actually end up doing. But keep in mind, easy money policy is going to remain in place. And they have to almost ignore the inflation. Chairman Powell said in front of the Senate again yesterday, if we see inflation persisting at higher levels longer than expected, if we have to raise interest rates more over time, then we will. So it's basically saying, look, when we start to raise, it's going to be a little bit, and we're really not going to do much until it becomes far more significant than what it is. So there you go, average American family. There's your $3,500 more you're going to spend in 2022 on your primary essentials than you spent in 2021. That's the real number that you need to expect budgetarily, $3,500.
Right, but isn't the next COVID spending package going to put that money back in our wallets?
Yeah, that's right. They've got to replace it somehow, especially if the markets do end up turning down. So the whole employment focus has been ineffective too. They claim an unemployment number, Miles, of 3.9%, which is laughable. So they claim that over here. And then over here, they talk about the fact that in November, nobody really probably even knows this, but workers quit their jobs at a record rate in November, and job openings stayed close to the highest ever levels. There are more jobs available out there, but you've got all these people quitting their jobs because they don't report the numbers accurately. They look better than they really are. Here's another Fed quote from yesterday. Inflation is running very far above our target, and that's telling us the economy no longer needs or wants the very accommodative policies we've had in place to deal with the pandemic and the aftermath. So it's one thing to pause, it's another thing to shrink. So to pause and in this tapering effect, that's what they can say that they're going to do. But he then says it's a long road to normal from where we are. So keep in mind, you've got high CPI, your consumer price index is just going to be here for a long time. And I hate to tell you this, but that's also why we're seeing political sensitivities increase.
That's like the dad who has refused to look at the map for the last 500 miles.
That's a great analogy.
And he's just looking back now and going, it's a long way back to where we should be.
I should have looked at the map.
Yeah, I should have looked at the map 27 years ago. Or whatever it was.
And they talk about spending more money to try to drive prices down. It's market control. And I'll tell you, too, in 2022, listener, it's going to be the energy sector. It's about to get ugly. Oil just crossed $82 a barrel today. It's also responding to a weaker dollar and weaker expectations. It's a 90% government-controlled market, and they're losing control. And it's now $82 a barrel despite their best efforts to drive it down, to drive meat prices down. They think throwing money at it can do it, and it's just not. All of this on top of Omicron numbers running sky high. So I'll get off my soapbox.
Well, I'm going to join you back on the ground because I think that's going to do it this week for Golden Rule Radio. So as always, we appreciate you stopping by. If you liked what you heard, hit the subscribe button, ring the bell. Head on over to our website if you'd like to learn more about us. That's McIlvaneyICA.com. We can be found on Twitter at ICA Gold or on Facebook at McIlvaney Financial. As always, if you'd like to discuss your personal portfolio with one of the advisors here at McIlvaney ICA, give us a call at 1-800-525-9556.
Thank you so much for listening. Have a great week.